What's going on? I'm your host, Colin Job. Another show right here on REMIC TV. Here with my special guest today, Dwight Dorrington. Dwight's a financial planner. We've been having a really interesting conversation so far on estate planning, and we're going to get to that in a few minutes. But we talked a lot about life insurance and why everyone should have it. And we're going to encourage all those men out there to talk about it, be more open to it.
Well, there's this discussion that should be had, yes.
And exactly, because as we mentioned earlier, unforeseen things can present themselves and alter a family's life greatly.
Big time.
I mean, my understanding is one of the sources of poverty is premature death. Am I correct in saying that?
Yes, it is. You have, most families now are two-income families. And when one of those incomes are taken away and is not replaced, now that family is really behind the eight ball. Their standard of living is going to be drastically reduced. They may have to sell the home and move out. They may have to move out of the apartment and move into something smaller. The prospects of the children having a positive life now have been dashed. And so when you have children, it's incumbent upon you as parents to sit down and determine, how do I take care of my family if something happens to me? The worst thing that happens on death is someone important and well-loved is removed from the equation. Their income should not be removed also.
Right, excellent
point. And what this insurance does, it replaces that income so that therefore the family can continue on with the lifestyle and with the goals that you had set for them because you provided this financial base for them.
So they can maintain the life that they've become accustomed to.
That's correct, that's correct.
Okay, let's talk about single parents for a minute. What about them? Do you find a lot of single parents are underinsured as well? Because a lot of...
Well, what I find, when you get to single parents, they're mostly women.
Okay.
And women do have more of a desire for life insurance than men.
Oh, really?
Because when you look at the dynamics, men live for fewer years than women.
Right.
So there are more widows out there than widowers. So consequently, women are always thinking about what happens if this happens. So when you have single women, they're concerned about, if something happens to me, what happens to my child? And they are interested in determining how to take care of that.
Okay, so the issue is we've got to get men to understand the big picture.
Yes. Yeah.
Interesting. And also, as you talk about insurance, some people talk about insuring a child, and I've heard some financial planners say it doesn't make any sense to me, and others are supportive of the concept. What are your thoughts on it?
Okay, the reason a lot of people don't talk about insuring a child is, on the death of a child, they do not want to reap a financial benefit. Because insurance is going to be money coming in. They do not want to be financially rewarded for a child passing away. And normally, you're looking to insure someone that is providing some type of income to the family. Children do not provide an income. They eat up the income. Okay. But the other reason you would look at insuring a child is if there is a history of some type of disease or illness with that family. Because if the child gets older and they develop that, they could become uninsurable. So if there's a family history, you would want to try to take care of that. Okay.
So I would assume that it would be more cost effective in the onset.
That's right.
As against the later years.
And the other thing is, a lot of the clients I have, they will buy what are called limited pay policies for their children. So they would pay premiums for 10, 15, or 20 years, then the policy's paid up. And then you have what is called a guaranteed insurability offer on top of the policy, so that as the child hits 21, every 5 years they can buy more insurance coverage up to their age 45 without having to provide a medical.
Oh, really?
So that allows them now to start building a legacy for their family without having to worry about what their health state is. So that's another reason that you would look at it. And then a third reason is, a lot of companies now have what are called dividend paying policies. You can buy it for 20 years. You say put $100,000 in place. At the end, by the time this child is 65, that policy could be worth $1 million.
So the policy, so for example, I want to make sure I'm understanding this correctly. So if we're starting off with a child, we're not going to buy $1 million policy.
No.
So we're starting off with a policy that has an increasing balance?
Well, what it is
an increasing benefit?
Yeah, you have a dividend part of that policy, and that dividend grows on an annual basis. It's like receiving dividends on stocks.
Oh, okay.
And that goes back to buy more insurance. So therefore, you get a child 2 years old, you pay for the policy until they're 22. By the time this child is 65, that policy could be worth $800,000 to $1 billion of life insurance. And the premium stopped when they were 22 years old.
Oh, really?
So those are things you can look at. And also with that type of policy, when this child is 30 or 35 and they want to buy a home, they can take money out of that policy for a down payment for a house and still have the policy carry on. So there are a lot of great features that can be put in place if you're so inclined as putting something in place for your child.
Interesting, interesting. But what I'm gaining from that is that you're saying that insurance is almost like an investment.
Insurance, in a way, is an investment. You are paying so many dollars per month for a benefit that is guaranteed to be paid out on your passing. That benefit is tax-free. If you took that money and put it into a mutual fund and let it grow over a 30 or 40 year period, you may not be able to get the same value out of that mutual fund as you would out of the policy, plus the mutual fund is going to be taxed. Whatever earnings you get on that, you've got to pay back to the government. So it's not you don't look at it as an investment, but it can work like one. And the beauty is, at the end of the day, when the funds are paid out, they are tax-free.
So that's significant savings.
That's huge. That's huge.
Interesting, interesting. I've never heard of that that concept as it relates to children.
Yeah.
That's really interesting. So as we go into, we're going to get into estate planning in a second. But I have one last question in terms of insurance. Sorry.
Sure.
I know there's generally a few different types of policies. Some people are term. Some people believe in term by term invested difference.
Yes.
Whole life, universal life, and I'm sure there are a few others as well. Mm-hmm. What are your beliefs and philosophies in regards to that whole by term invested difference concept?
The problem with the by term invested difference is this. Term policies usually have an end date, anywhere from age 75 or 80. The policy is going to end up not being there anymore. And you don't know when you're going to die, right? The other thing is, most times you need insurance for your estate to protect it from the tax man. So if you're buying term and investing the difference, you're building up, by investing that difference, property tax liabilities that will have to be paid on your passing. And if the term is gone, who's going to pay the tax liabilities?
Okay.
So the other problem with buy term and invest the difference, most people don't invest the difference. They buy the term, they spend the difference. Okay. So consequently, you don't win. You have to be very, very motivated to follow that through, because all of a sudden you want something, the money's in the account, I'm going to get it.
Just tap into it.
Right. Whereas with a policy that is not structured that way, the money's more or less locked away to a great degree.
So for a lot of people, it's buy term, lose the difference.
Yeah, because they don't do anything with it other than spend it today.
Interesting, interesting. So hence, I guess, the need for a needs analysis at the onset.
Yeah, and also when you look at a proper insurance program, you will have term and you will have permanent. Because when your mortgage is paid, you don't need insurance to cover that. When your children are adults, you don't need insurance to cover that. That's where the term insurance comes in, to take care of a liability for a set time frame. Permanent is because you need it when you die, you don't know when you're going to die.
Interesting, interesting. Very interesting. So let's touch on estate planning now.
Okay.
And you mentioned before, it's about building that legacy, creating the generational wealth.
Yes.
And it's, to me, the twist from the sounds of it, like you said, it's something that rich people do, right?
Yeah, that's the concept.
So, well, why is it important for the average guy out there?
Well, what you're looking at is anything you own is part of your estate on your passing, okay? And so consequently, if you do not have a will in place to indicate where this is going to go, the government comes in and determines where it's going to go. And the government, not that they're bad people, but they don't know you. And the rules they make are generic. So therefore, whatever they're going to bring in place is not going to benefit your family, technically. It's just that this is the way it's written up because they have to put a standard rule in place.
So just law.
It's law. So the thing is, most people don't know what the laws are. And therefore, by leaving your estate to the government, you are doing your family a disservice.
Interesting. But I think the thing is, a lot of people they don't even look at it like that. It doesn't even occur to them. You know what? I think one of the challenges is that people deal with death issues at the time of death, and I think what we need to do is find a way to get people to think about it while everything's going good.
Well, that's the thing that I preach a lot is no one likes to talk about life insurance and estate planning because it talks about death. But I taught my children at a young age, we're all going to pass away. Let's enjoy our life, but we're all going to pass away. So what you want to do is start bringing to them the need to have their affairs in order at any time in life. And as you go forward in life, you are always going to be updating your will so that your estate is going to be properly taken care of. The same way as you go through life, you update your insurance because things change. You may be overinsured, so you get rid of some of the insurance. You may be underinsured, you get more insurance. But this is a process that grows with you. It isn't put it in place now, forget about it. It's put it in place now and review it as time goes on.
So the best idea is to start as young as possible then.
As soon as you have something that you own, set a will up to determine who's going to get that on your passing. So you can be 23, 24, 30, set up a will. It doesn't cost that much. It costs a lot more not to have one than to have one.
Great, great. So great information there. Hold that thought. We have lots more to touch on. I don't mind talking about it. We're hoping that the listeners do as well.
Okay.
And we'll be right back, right here on What's Going On REMIC TV.